The job market is shifting. What we're seeing today is very different than what we saw in the job market back in 2022. Back in 2022, quiet quitting was everywhere, the great resignation was in full swing, and employees could quit their jobs and see huge salary bonuses by getting a new job. Today, it's a very different environment. Now, if you're quiet quitting, you're probably going to get fired. People don't want to quit their jobs anymore.
Hey, speaking of quiet quitting, earlier today I heard they made up a new term called loud quitting, which is y'all have seen it on TikTok where people record themselves getting laid off. Yeah, I'm gonna be making a video about that later on this week.
Or because the job market isn't as strong as what it was, and even if you do get a new job, you might not see the same pay raise that you saw before. I've talked about this a lot over the last number of years, but the power dynamic between the employer and the employee have been shifting. Back a couple of years ago in 2022, the power was in the hand of the employee. You had much more power because employers were more desperate for employees than employees were desperate for jobs. There were a lot of job openings and not that many people that needed a job, so employers were much more desperate for employees, so employees had the power. Now in 2024, it's become much more even, and so the power dynamic has shifted.
And I believe it's going to continue shifting over to the employer. Obviously, this video is a couple of months old. It's 2 months old because he's talking about 2024. Obviously, it's 2025 now. But that leads to the question of the day. Do you believe personally that the job market is better or worse when employers have the power? Based on the economy in 2022 versus currently in 2025, you might feel like it's obvious to say it's better with the employee because everybody was eating good in 2022. But not only do the actual employers disagree with that, there's a good bit of people, especially online, that don't like the fact that there are people that try to fight back against shady business practices in the workplace and that feel like, you get what you get. If you're coming in here trying to change anything, if you're coming in here making any demands, you're entitled and you're the problem. We see that especially with older people, Gen X and boomers, talking down on Gen Z now entering the workplace and younger millennials, but I don't even want to get into that issue. We already did a video about that. I'm going to let the video play. I'm going to let them rock out a little bit. I'm going to probably do a little bit less talk in this video because I want this video to be more of an educational space than an argumentative space like we do on a lot of videos.
That changes a lot of things when it comes to work culture. For example, you're seeing many more employers feeling more confident in implementing stronger work policies, such as return to office. And along with that, wage growth has been falling pretty steadily. And that's why in this video, I want to go over 3 things. Number 1, I want to go over the state of the job market. Number 2, I want to go over the state of salaries. And number 3, I want to go over what this means for the future for you and the job market. But first, here's a quick word from our sponsor, Vanta. If you are starting or scaling your Let's start by taking a look at where unemployment is. Back in 2022, the average unemployment rate in the United States was 3.6%. In 2023, it was also 3.6%. Right now, at the time of recording this video, it has jumped up to 4.1%, which historically is still extremely low. But it is a little bit higher than where we were over the last couple of years. Now, the interesting thing about this unemployment number is when we got the most recent jobs report, it came out much better than what economists even expected. Which brings us to the important question. How are interest rates impacting the job market and the unemployment numbers? We know that as interest rates went up between 2022 and 2023, we saw a surge in layoffs. Right. And now as interest rates go down, economists and the Federal Reserve Bank are hoping that this is going to help stimulate the job market even more. And just to make sure we're on the same page, the reason why higher interest rates have contributed to more layoffs and a rise in unemployment rates has to do with a couple factors. Number 1, there is the debt burden on corporations, and number 2 are the slower sales that corporations see. Starting with the debt burden, we know that most corporations in the United States, or many corporations in the United States, have.
As a marketing consultant, there's no better way to stay connected with your clients and leads than with Honeybook. So for
debt. And many of these corporations refinanced their debt back in 2020 and 2021 when interest rates were at their lowest levels ever. Right. Well, corporations don't get a 30-year fixed rate mortgage. They get a 3-year or 4-year or 5-year term on their loans. And so in 2024, many corporations for the first time are starting to see these debts start to readjust at a much higher interest rate than what they readjusted it at back in 2020 or 2021 when interest rates were at their lowest levels ever. Which means for corporations, their costs of doing business are rising, not just because of inflation, but because their debt servicing costs are rising.
But here's the thing. If the cost of doing business is rising and interest rates are rising, now I'm just asking a question. I could be completely off here. Y'all can let me know if I'm off. But why then do we see all of these return to office mandates in an attempt to fill all of these empty office spaces because the companies are paying for the space, when the play should be to optimize, potentially let go of a space if it's that big of a deal, and let people work from home. I know people get a lot of blowback for advocating for working from home, especially now that it's going into 2025. But I mean, if the objective is to keep costs low, why not find another way rather than letting layoffs be the first resort? Because as we know, layoffs have been and probably will continue to run rampant. And the easiest way, or at least companies see it as the easiest way to stay on track, to hit your earning targets, to hit the numbers that you need to hit, is to just start letting people go.
Even if a business hasn't changed how much debt they have, their cost on the debt will go up when the debt readjusts. But the second part to this isn't just now the business paying more interest on that debt. It's the fact that slowing sales can also be caused through higher interest rates, because when interest rates go up, that makes borrowing more expensive. And we live not only in a consumerism culture, but we live in a credit-based spending culture, which means our economy runs on credit, not just the cash in their bank account. So if somebody has $100 in the bank account, that doesn't mean they can only spend $100. It means they can spend $100 plus whatever Visa will give them. And when interest rates go up, people are less likely to go out and put money on their Visa, and Visa is less likely to extend as much credit. That means that spending abilities go down when interest rates go up, and businesses need people to spend money in order to sustain their sales. So as interest rates go up, the cost of a business also go up, because that means they have to pay more money on that debt, and then revenues can also get hit or not grow as fast, because that means people and businesses can't spend as aggressively as they were before when interest rates were lower. And that's how businesses get impacted when you have higher interest rates.
Okay, that makes sense. In simple terms, the higher the interest rate gets on your credit card, the least likely you are to actually use your credit card. And if you're least likely to use your credit card, you're least likely to go out and spend money with all of these various corporations, which then causes the corporations to start struggling. Pretty simple in theory, but I still don't believe that mass layoffs are the answer to that issue.
To really hammer this point home, take a look at what Goldman Sachs published. They published an article on their website titled, "Is United States Consumer Spending Losing Momentum?" And then they went on to say that spending growth has slowed from above 3% in the second half of last year to a trend rate of probably around 2%.
Also, keep in mind, spending slowing down, I'm not talking about like interest rates, I'm just talking about spending in general slowing down, is a result of everything. It's not just, rising interest rates. It's a result of the cost of food going up, the cost of living in general. Vehicles are way overpriced. Home prices are starting to get more and more out of reach. We're to a point to where 1/3 of people under the age of 30 are still staying at home with their parents in an attempt to save money. So naturally, if everybody is in save mode and everything is super expensive, people are just going to spend less money.
Today in 2024, which again means that as interest rates go up, businesses might not be able to forecast as aggressive of sales as they can when interest rates go down, and people can go out and borrow more money easier. But now you have a lot of businesses hoping the opposite will happen, that now as the Federal Reserve Bank is cutting interest rates, it will number one, stimulate spending, and number two, it will allow businesses to readjust their debts at a lower interest rate. And this is where everybody is wondering how aggressive the Federal Reserve Bank is going to be when it comes to cutting interest rates. Now, when you get numbers that the job market is stronger than expected and inflation is better than expected, that doesn't give the Federal Reserve Bank much fuel or ammunition to keep cutting interest rates very aggressively. And this is where a lot of people on Wall Street and every investor is paying attention to what the Federal Reserve Bank does, because they want to know how aggressive are they going to be when it comes to cutting interest rates, because that can impact, number one, how expensive the debt is going to be for corporations, and number two, what future sales might look like for those same corporations. And this brings me to number two, the state of salaries in America. Now, salaries have risen across the board between 2019 and 2024, but that doesn't give you the full picture. And what you want to pay attention to is how fast are salaries rising relative to the price of things. And what we've seen is up through the beginning part of 2024, inflation outpaced salary growth. But then in the beginning part of 2024, we finally got the good news that wage growth was outpacing inflation. And that naturally had a lot of people very excited. But let's take a look at this chart. If we zoom out, what you can see is that there was this big period where inflation was outpacing wage growth. And now, as wage growth is outpacing inflation, does that make up for the big gap where inflation was outpacing wage growth? So let's dig into the numbers. Between 2019 and 2024, the reported inflation number over these 5 years is just over 23%. I'm rounding down here on the inflation numbers over there.
And obviously, moving forward, the numbers here are only going to continue to grow. Houses and cars are only going to continue to get more expensive. Wage growth may or may not actually keep up with it. You guys know I say in almost every video when we're talking about job markets and getting a job that typically whenever when you're working, you want to be moving either up in your company or out of your company every 2 to 3 years in order to hit the salary numbers that you actually want to hit. But now that there are less jobs available and wage growth in general is just slowing down, we're starting to see people are less likely or more reluctant to leave their job out of fear that they won't be able to have anything else lined up. It's really a crazy phenomenon, but I'm gonna go ahead and cut it right here. The link to the original video is down in the description below. Y'all make sure y'all go show Minority Mindset some love and drop y'all thoughts about this down in the comments below.